Welcome back. Today we are going to solve four problems from SFM paper concept, which is topics which is forex, equity, and then portfolio management, one problem, and then mutual funds. Okay, four concepts we are covering in this: mutual funds, forex, portfolio management, and then equity valuation. Right? Okay, we'll understand all these concepts very simple only. If it comes now, we can easily score 7 marks uh, in SFM paper. Okay. Okay, let's quickly read the question. Mr. Ran, an investor, owns a portfolio with the following characteristics, and it is assumed that the security returns are generated by two-factor model. Okay, two-factor model. What they are saying is security returns are having two factors, which is two betas, two different betas, which means that two different risk. In real life, this is the actual scenario. One side there will be inflation, one side there will be war, one side there will be market crash. So all these things will be happening all these things will affect the stocks securities. So in this problem we are going to face that only, but we are solving with the two factors, which is factor 1 sensitivity, factor 2 sensitivity. They have given for both the securities, and risk fee also they have given. What they have asked us to find out is we have to find out the portfolio beta when they invest 1,80,000 by selling short 90,000 of security gain and purchases 2,70,000 of security MB. And okay, we are going to find out. And then they also borrow 1,80,000 to purchase risk-free securities and invest the amount. Okay, they have borrowed and invested in risk-free securities and borrows along with the original amount of 1,80,000. Okay, along with the original investment, they have already have 1,80,000. No, along with that they have also got another borrowing, and in the same proportion means previously what they had in proportion, they are having the same proportion as the part 1. Okay, and the sensitivity here also we have to find out the portfolio beta, and at the last we have to calculate the expected return premium. In this with the information given, we can use the CAPM and find out the expected return. Right? Okay. Now what we have to do is particulars. How we can solve this? One single table only, there is no much steps in this. Okay, let's quickly go by that. Okay, particulars, which is nothing but the stocks, investments. We have to find out the weights. In which formula this is working is portfolio beta. Portfolio beta is nothing but weight of A, security A into beta of A, plus weight of B into into weight of B into beta of B, and it goes how many securities in the portfolio with how many in how much weight they have accommodated in the portfolio. Okay, so weights we have to calculate, and then beta we have to take. Okay, right, a beta 1 and weight into beta 1. Okay, then beta 2 weight into beta 2. Okay, right, MB KN. What's the investment? They have 1,80,000. Okay, what they have invested in security gain? They have short sold. Okay, 90,000 they have short sold, and the purchased is 2,70,000. So 2,70,000 divisible by 1,80,000, which is 1.5. 90 lakhs divisible by 1,80,000, which is 0.5. What's the beta? Beta is MB beta is 0.8, K in beta is 1.5. Multiply both the things. 1.5 into 0.8, which is 1.2. 0.5 into 1.5, which is 0.75. What's the portfolio of beta factor 1? 0. Wait, plus 1.2, 0.45. Okay, same we are going to do with the beta 2. Beta is what here? Beta 2 is 0.60 for MB, 1.10 for KN. Right, multiply this again. 1.58 into 0.6, which is 0.9. 0.5 into 1.1, which is 0.55. Okay, plus 0.9, which is 0.35. Portfolio beta factor 2. Right. Okay, then we have found the portfolio beta factor 1 and beta factor 2. Now we have to find out the same for another proposition. We said no. One minute. What I have said? They are borrowing and same proposition, but they are borrowing 1,80,000 to invest in risk-free securities, but the capital itself is 1,80,000 only. But the thing is, they are putting in the same proportion as in the part 1. Here, since our investing capacity is doubled, our allocations in the MB and KN also doubles. Okay, how much the same proportion means 5,40,000, 2,70,000 into 2, 90,000 into 2. Okay, 5,40,000 minus 1,80,000 minus 1,80,000. Yes, okay. 5,40,000 divisible by 1,80,000, which is 3 is the weight. 1,80,000 divisible by, which is minus 1 minus 1 comes to 1. Okay, beta is how much? Same, 0.8, 1.5. Risk-free security beta is 0. 0.6, 1.1. risk-free security is 0, so always 0 only. So weight 3 into 0.8, which is 2.4, 1.5, and then 3 into 0.6, which is 1.8, 1.1, 2.4 minus 1.5, which is 0.9. This is the portfolio beta factor 1. Portfolio beta factor 2 is 1.8 minus 1.1, which is 0.7. So we got the values in this proposition also. The third one they are asking is to find out the expected return premium of factor 2. Expected return premium we have to find out. How we are going to find out is, it's okay. Now, what's the CAPM formula? If in case of multi-factor model, RF plus beta into factor 1 plus beta 1 into factor 1, beta 2 into factor 2. What they have asked us to find out is, we have asked us to find out the B factor 2. What's the risk-free return? Risk-free return is 10%. Okay, 0.1. What's the CAPM in case of security MB? 15%, 20% for KN. Beta of 1 is MB only, right? 0.80, 0.60, 0.8 to 0.6. 1.5, 1.1. Okay, let's quickly do the works. Okay, 0.1 is equal to 0.8 F1 plus 0.6 F2 is equal to 1.5 F1 plus 1.1 F2. Okay, multiply this value here, this value here. Okay, this equation into 1.5, this equation into 0.8. When we do this, 0.075 is equal to 1.2 F1 plus 0.9 F2, then 0.8 into 0.1, which is 0.08, is equal to 1.5, which is 1.2 F1 plus 1.1, which is 0.88 F2. Strike out both the things. 75 minus 0.08, which is minus 0.005, is equal to 0.9 minus 0.88, which is 0.02 F2. F2 value is which is 25%, minus 25% is the F2 value. So we have done with this problem. We'll go to the next problem. Next problem is very simple. Forex, just we'll arrange the values. Rupee per dollar. Okay, spot basic rate, ask rate. What's the spot rate? 46.25, 47.5, right? So they have given the question. Now let's quickly jump into the problem. What they have asked is, how many US dollars should a firm should sell? The firm is having US dollars in hand, so they'll be selling dollars and buy rupees. Okay, if they are selling dollars, means dealer will buy at the bid rate. Okay, bid rate after 2 months, then 25 lakhs divisible by bid rate is 47, dollar 53,191 is the dollar will be getting after 2 months. The next question is, how many rupees in the firm required to pay so as to obtain US dollars 2 lakh in the spot market? They want dollars, they'll be buying dollars, selling rupees, right? If they are buying dollars, means bid the dealer will sell at the ask rate. How much dollars they want in the spot market? 2 lakh dollars into what's the ask rate in the spot market? 46.25, which is 46.25, which is rupees 9 lakh 25, sorry, 92 lakh 50,000 they have to pay. Okay, then assume that the firm has $69,000. They're thinking that whether to encash it today or after 2 months, because if they are encashing now, they have opportunity to get 10% per annum for 2 months forward market. Okay, if they are selling the dollars, means the dealer will buy at the bid rate. What's the bid rate today? Today's bid rate is 47, 46. This is 47. 69,000 46, which is 31 lakh 74,000. 69,000 into 47, which is 32 lakh 43,000, plus what's the interest for two months? 3174,000 into 10% into 2 by 12, which is 52,000 900. Okay, 74,000 plus 50,900, which is 3 lakh 32 lakh 26,900. Although we have added interest, this is seems bigger, so the difference is the gain for investing for converting after 2 months in forward rate. Okay, then we'll go to the next problem. The next problem is the December 25 problem. Let's quickly solve this problem. Very simple problem. When it comes to NAV calculation, we have to use Macho. Okay. Now what they have asked us to find out is net asset value. They have given all the investments in the portfolio, and also they have given the unlisted bonds value, cash at the year end, and the expenses payable, which is 5 crore at the uh, over the period of fund. Okay. Now they've asked us to find out the NAV value. No, so particulars, amount. They have given the index at the time of purchase and at the time of valuation. So we are going to just adjust the values by the index inflation rate. Okay. So amount. What's the IT, infra, aviation, auto, bank, unlisted bonds? These are all the investments. This is marketable value of securities, and then comes accrued incomes, if any, and then comes cash. Okay, once we have added all this, we have to less what's that, accrued expenses, and then outstanding liabilities. This is the macho, MACAO. Okay, so this is the structure we have to follow. Instead of no getting remembering the things will take time, so we can use the mnemonics to make it faster. Now what's we have to get the NAV, total NAV divided by number of unit holders. We'll get the NAV per unit. Okay, now 35 crores, 20 crores, 10 crores, 25 crores, 15 crores, 20 crores. Okay, this the opening values. What's the index? We have 3100 divisible by 1800, 2550 divisible by 1500, 2300 divisible by 1400, 2800 divisible by 1750, 2500 divisible by 1600. Okay, using this indexation, we are going to bring up the values to the current date. Okay, now cash is, what's the cash is balance 4 crore, and outside and the accrued expenses, which is 5 crore. Okay, yes, we have added everything, set to go. Okay, 35 into 3100 divisible by 1800, which is 60.28. 20 into 2550 divisible by 1500, which is 34 crore. 10 into 2300 divisible by 1400, which is 16.43. 25 into 2800 divisible by 1750, which is 40. 15 into 2500 divisible by 1600, which is 23.44. Then comes the unlisted bonds. Directly there is no indexation for unlisted bonds. What's the total? Total this up and total this up also. 35 plus 20 plus 10 plus 25 plus 15 plus 20, which is 125 is the total NAV, opening NAV. 60.28 plus 34 plus 16.43 plus 40 plus 23.44 plus 20 plus 4 plus 5, which is 203 point. Is this correct? 1 minute. 60.28, 34, 16.43, 40, 23.44, 24 plus 5, which is this we have to less. Okay, next time, which is 193.15. Okay, what's the number of unit holders? 7 crore. 125 divisible by 7, which is 17.86 is the NAV per unit. 193.15 divisible by 7, which is 27.59. so this is the NAV at start, this is the NAV at the end. Okay, what's the dividend we have in this period? Dividend is 3 per unit, rupees 3 per unit for per year. Okay, and then what else they have asked us to find out? They are giving the scheme which is the period, no, 2 years period. Okay, so dividend is rupees 6 per unit. So what's the return percentage? D plus P1 minus P0 divisible by P0 into 100 is the formula. What's the D? 6. P1 is 27.59 minus P0 is 17.86 divisible by 17.86 into 100. 6 plus 27.59 minus 17.86 divisible by 17.86 into 100, which is 88.07 is the percentage rate for 2 years, divided by 2, 44.036 percentage per year is the return out of this mutual fund. Okay, we have solved the mutual fund problem also. Let's go to the last problem, which is from equity valuation. Problem is very simple. As we already see in the yesterday's problem, here we have to put D value, growth rate, cash flows will be getting present value of cash outflow, present value of cash flow. What's the year? What they have said in the question is earnings are given on Raksan Limited. They have given 10% is the growth rate. Okay, for the first 4 years. Okay, first 4 years the growth rate. After 4 years, the growing rate dividend is expected to decline to linearly to 7%. So per year, it will be reducing slowly, and then it will be standardized at the 7% at the 7th year. Okay, the last dividend per share, which is last dividend, is already paid rupees 3, and the required rate of return is 16%, which is KE. Okay, we have got all the values. Now just quickly plug into the table. 1, 2, 3, 4, 5, 6. What's the D here? D is 3, right? What's the growth? Growth rate is 1.1 for the first year. For the 4 years, 1.1 only. And then for 5th year, 1.09. For 6th year, 1.08. After that, it's going to stabilize with the 7% rate. Okay. So 3 into 1.1, which is 3.3 into 1.1, which is 3.63 into 1.1, which is 3.993 into 1.1, which is 4.39 into 1.09, which is 4.79 into 1.08, which is 5.17. What's the PV factor? PV factor we have is 0.862, 0.743, 0.641, 0.552, 0.476, 0.410. Okay, what's the if we multiply this now, we'll be getting the present value of dividends. Okay, 3.3 into 0.862, which is 2.84. 3.63, 3.63 into 0.743, which is 2.69. 3.993 into 0.641, which is 2.56. 4.39 into 0.552, which is 2.42. 4.79 into 0.476, which is 2.28. 5.17 into 0.410, which is 2.12. Okay, we have now brought the dividend values of various different years into the first year. Now you have to calculate the value of equity. You have to know the present price at price at 7th year, price at 6th year also. How to calculate the price at 6th year? P6 is equal to D7 divided by KE minus G. What's the D6 D7? 5.17 into 1.07, growth rate 7%. KE is equal to, KE is 16%, 0.16 minus what's the growth rate? Growth rate is 0.07. Okay, 5.17 into 1.07 divisible by just 9% divisible by 0.09, which is 61.47 is the P6 value, which is 61.47 we have calculated. Okay, working note 0.410 into 0.410, which is 25.2. Total all these up will be getting the value of equity 2.84 plus 2.69 plus 2.56 plus 2.42 plus 2.28 plus 2.12 plus 25.2, which is 40.11. So that's it, the problem is over. Thank you. For this question there is a no and suggested answer gives workings for suggested answer given. Okay, you can take this as the reference. Thank you.